All right, let's dive into a massive puzzle happening in the Bitcoin world right now, and it's all about MicroStrategy. See, they're buying Bitcoin like there's no tomorrow, but their stock, it's taking an absolute beating. It's a paradox that has a lot of people scratching their heads, and today we're going to unpack it.
So, this is the core question, isn't it? How on earth can a company be spending billions of dollars to load up on its main asset, Bitcoin, only to watch its own stock price just plummet? What is really going on here? And this visual just says it all. I mean, look at this. On one side, you've got this huge arrow shooting up. That's their Bitcoin buying. On the other side, a steep, painful drop. That's their stock. You'd think these two things would move in the same direction, but they're not. So let's break down exactly why.
First, we really need to get a handle on the sheer scale of what's happening. We are not talking about a few small purchases here and there. No, the company has kicked things into a completely different gear.
$1 billion. Just let that sink in. In just the last week, MicroStrategy deployed nearly $1 billion to buy more Bitcoin. That's a staggering amount of cash for such a short window of time.
And that $1 billion bought them roughly 15,000 more Bitcoin to add to their treasury. I mean, there's no doubt about it. They are the most aggressive corporate buyer in the market, bar none.
But here's what's really interesting. The pace. This is the third week in a row that they've dropped about $1 billion. This isn't just a one-off headline anymore. This is a sustained change of pace. It's a signal that they are flooring the accelerator. So, the crucial question becomes, how are they paying for all of this?
So how are they funding this incredible shopping spree? Well, the way they're paying for it all reveals a really deliberate shift in their strategy, and it tells us a ton about the current market. If you look at this latest $1 billion purchase, it was funded almost entirely by selling their own common stock through something called an at-the-market or ATM program. They raised nearly $900 million this way. A tiny fraction came from preferred stock. Now, this is a big change in how they do things.
You see, MicroStrategy basically has two main ways to raise money. The preferred stock is aimed at investors who are looking for specific kinds of returns. But the common stock ATM, that's their most direct, most flexible tool for raising cash fast. And right now, they are leaning heavily on that flexibility.
So why the sudden pivot? Well, it's just pure logic. Some of their preferred stock options are currently trading for less than what they were issued for. And when that happens, it's just not efficient to issue more of them. So instead of forcing it, they adapted. They pivoted right back to their most reliable tool, the common stock ATM.
Now, you might hear all that and think they're being forced into a corner. But the reality is actually the complete opposite. This is not a move that's coming from a place of desperation. It's a calculated, opportunistic play from a position of real financial strength.
This really just sums it up perfectly. This isn't some defensive reaction to market pressure. It's an opportunistic choice to deploy capital like crazy because they believe they see a golden opportunity.
And here's the key that makes it all possible: the dividend reserve. The company already put aside a massive $1.44 billion war chest specifically to cover all its interest and dividend payments for the foreseeable future. This basically removes any short-term stress about paying the bills and gives them the freedom to make these huge moves without putting the company at risk.
Okay, so if the company is financially stable and they're acting opportunistically, why is the stock falling off a cliff? Let's unmask the real culprit here, because it is not what most people think.
The numbers don't lie. It's been a brutal ride. Over the last day, month, and 6 months, the stock has been hammered. We're talking down over 53% in half a year. That is a painful experience for any investor.
Now, the easy explanation is to blame dilution. You hear it all the time. People see the company issuing new stock, and they just assume that's what's crushing the price. But the data actually shows that the selling pressure from them is pretty modest compared to the stock's normal trading volume. That's just not the main story.
The real driver is the performance of the underlying asset, Bitcoin. A share of MicroStrategy is basically a leveraged bet on Bitcoin. So when Bitcoin is weak, MicroStrategy's stock doesn't just follow it down. It often falls even harder. The stock's pain is a direct reflection of Bitcoin's own struggles.
And why is Bitcoin struggling? Well, because right now, it's in a lonely market. I mean, think about it. Outside of MicroStrategy, corporate buying has pretty much ground to a halt. The initial excitement around the Bitcoin ETFs has cooled down, the flows have slowed, and there just aren't many other big, consistent buyers stepping up to the plate.
And that brings us to the core thesis of this whole situation. MicroStrategy is acting as the one major, constant bid in the market. But as powerful as they are, one buyer alone cannot prop up a multi-trillion-dollar asset. They can keep buying, but they can't single-handedly lift the entire market.
So the takeaway here is this. MicroStrategy is executing its strategy with incredible discipline, using the tools they have from a position of strength. But ultimately, the success of that strategy and the performance of their stock is going to be decided by what Bitcoin itself does next.
Which leaves us with a fascinating question to chew on. In a market that is testing everyone's conviction, is MicroStrategy's decision to double down this aggressively a visionary masterstroke that's going to look brilliant in hindsight, or is it a massive misstep? Only time, and of course Bitcoin's price, will tell.